It's a true honor to be standing in front of so many of you, and it's a testament to really people's interests around the space that we now have literally like 500 people here during the course of today. The vision that, I had 4 or 5 years ago about what really this should stand for. And it really comes down to one word, and that word is very simple and very straightforward. It's education, around the subject matter of volatility and volatility as an asset class. Because there is something in the volatility space for everyone.
This is by far the most interesting time in my 20 years in the industry, in being involved in equity volatility. And obviously we've seen a huge decline in the VIX over the last 4 years, and that changes the opportunity set quite materially, but also creates new and different opportunities.
What I think is imperative is a lot of people buying insurance type products, whether it was a tail fund, a volatility ETF. As Wall Street often talks about, past performance is not indicative of the future. I think it's imperative to keep your mind focused on, that and not throw the baby out with the bathwater because you had a bad experience in the past buying volatility.
I think more on the single stock side and on the single name side, I think there are a lot of opportunities right now, and without getting too much into the rate side of the world, there's a lot of opportunities to own growth equities and short corporate bonds. The concept is be long the stocks, be short the rates and the credit, and hedge your stock exposure by being short credits.
That's effectively what policymakers are doing. I mean, granted, they're not trying to make sure that I don't win, but they are disrupting markets in non-economic ways.
The mission statement is a free world-class education for anyone, anywhere. And she said, well, that's ambitious. How do you plan on doing it? And I said, well, I want to keep making these videos. We can get other people to make it in other domains. We can translate the videos, but we can actually get a software team to build out a lot of that initial stuff that I'd made for my cousins. We could have tools to give more practice on any possible thing, feedback, diagnostics, dashboards, analytics for teachers. Some of those reports, those rough reports that I was using as a tutor, I was finding them valuable. Bill Gates had said that he uses Khan Academy with his kids, he uses it with himself, which made me a little nervous. Those videos were for Nadia, not Bill Gates. My belief is that in the next 10, 20, 30 years, something like access to opportunities, free world-class education, will be kind of viewed as a human right, will be viewed as like clean drinking water or electricity.
Even if you subscribe to the notion that the central bank initiatives remove some sort of downside tail from the market, that doesn't mean that we're necessarily going to be in a de facto low volatility regime. I think people typically associate volatility with downside events, but there may be circumstances where the upside tail can actually expand and accommodate a higher volatility regime than people expect.
Japan has had an enormous thirst for these types of strategies, and you look back and say, well, why is that? And you look at their yield environment. For the last X amount of years, Japan has been really in the same yield environment that the current US and European markets are today. So I think some of the unintended consequences of what the Fed is doing is, in this audience, you're all probably saying, how are we going to make more money? And I've always said that I think the best thing that can ever happen to tail risk strategies is if assets inflate. So we want investors to be able to make 12, 13, 14, 15%, because when the average portfolio is only making 4 or 5%, it becomes very unpalatable to spend 50 basis points on tail risk strategies.
What are the benefits and some of the challenges of being long volatility to hedge equity exposure, as opposed to you might say, more direct hedges?
If you can move away from just the generic strategy of buying downside S&P 500 puts as a portfolio hedge, you can now actually find a lot of trades where you have implied trading a discount to realized. So you can construct a basket of trades that instead of having those headwinds is actually now is going to have tailwinds, putting you in a position where even if the vol regime remains low, you still have edge, you still have a positive expectation, while at the same time, of course, having the huge upside that comes from the eventual day when vol does in fact spike.
We're a year into this now,
and we're actually about 15 months into doing this. Last year I talked about the why of protection. Why would an endowment, and there aren't many doing it, why would an endowment or any large investor decide to invest in something, as the last panel pointed out, that has a negative expected return? This year, 15 months in, I'm going to talk about the how of protection and sort of what are the lessons learned from doing all this. When you take something that reduces your standard deviation of your portfolio and it's negatively correlated with the portfolio as well, it actually has less of a bleed impact on the portfolio than it does on a standalone basis. So there's a few things that we don't want in our program, and we certainly don't want anything that has short optionality or that has wrong way higher order risks. So I don't want to fund one crisis by paying with something that falls apart in a slightly different crisis, because I don't know what the next crisis is going to look like. So there has to be a certain amount of humility versus hubris in setting this up. You can't just fight the last war, but you've got to think that the next time it happens may look a little bit different. Tail protection programs are not made to make money in those sorts of situations, right? If we had had a program in place and had gone through the fall of 2011 without making any money, even though I could explain to the committee that that wasn't the sort of crisis that they were trying to protect, it would have been problematic, right? And so you have to offer your committee sort of no surprises, but also you have to give them some little gifts.
It's very important for us when we invest in public market hedge funds to lever off their best ideas.
What are the characteristics you're looking for when you're considering an external manager?
Solid history of consistency and kind of excellent performance, but we also would look to this manager for the unique insight that manager would bring to our point of view. They would bring an insight that we wouldn't have anywhere else in the book. They look at the markets very differently than any of the other guys, including even multi-strategy guys who have a broader mandate globally.
Our core driving factor for being able to justify a hedge fund manager in the pension suite of managers is that there's got to be an absolute return over the long-term period.
On the short vol sides, the vol risk premium, so that difference between implied to realized volatility, is fairly rich, and it exists for a reason across most asset classes.
So what you typically see in derivative space is that there's a high level of expertise required, right? So, and you can simply not expect that level of expertise to be there throughout the whole governance structure. The question is, how do you deal with that? At some point, the expertise stops, but the comfort needs still to be there.
Indeed. So the key is education. So you need to get everyone on board and everybody comfortable with what you're doing.
We very much view vol as an asset class. The standard definition of volatility is a statistical measure of dispersion of returns. Thanks to Black-Scholes, we have a way of extracting volatility as something that can be invested in.
Volatility managers generally tend to sit in the hedge fund or absolute return allocation. Now, the typical endowment or foundation hedge fund portfolio, which will have a dozen managers, will generally, if you look through, especially in a more modern one that isn't heavily long-short centric, will have 2 or 3 vol managers. I really applaud Mike Edleson's piece. Just in terms of products, the best ones that I've seen have not been strap on a tail risk hedge or buy or invest with a tail risk manager, but invest with a manager who happens to have tail risk hedging as part of a larger thing that they do.
Well, over the past 3 years or so, there's been a lot of conversations about tail risk hedging. Our approach is we recommend a diversified portfolio of active sort of tail risk or other negatively correlated managers.
Paul mentioned that one of the positive aspects of potentially having a tail hedge fund is you can play more aggressive offense in some of your risky assets.
Once again, a great event. Look forward to seeing you all in the 5th Annual Global Volatility Summit.